Just like you, I'm always excited to buy stocks. And right now, there are 3 stocks that seem to be into my buying price right now. And this month, as long as they hit the price I need them to hit, I am going to be purchasing more of them. Now, these aren't hype plays. They're smart, steady, and I think mispriced stocks that can build and compound wealth over the long run. Let me show you exactly what I'm buying and why I'm buying it. Also, I'm going to share what's going to take for me to pull the trigger on each one of these this month. The first one, PayPal. Now, guys, PayPal, a company I've been talking about for a while. What really first garnered my attention on PayPal was this. All-time high of 310. Started to hit a low earlier this year of 55. I started buying. I don't remember the exact price I started buying, but it was sub 80 for sure. And it's fallen. I was buying into the low 50s. And that made a lot of sense to me. And the low 50s were hit sometime last year. This is a company that's selling for 12 times free cash flow, 15 times earnings. But I love the fact that the free cash flow is higher than their earnings. $6 billion last year versus $4.5 billion in earnings. The last 5 years, $5.2 billion versus $4 billion net income. This is often missed because most people are focused just on net income. They have an increasing return on capital. I love seeing this. Last year it was 13%. This is a company that's going through a turnaround, but remember, they own Venmo, and they're very trusted in all online payments. So let's look at some more things about PayPal. Guys, it's 8 pillars. Now remember, 8 pillars aren't here to say, oh, we have all 8 pillars, we should buy them. No, it's about telling a story. These are all green, right? A couple things I'm gonna look at. Good, low debt. Buying back shares, love that at these low prices. Cash flow has grown $2.2 billion. Net income has grown $2.7, while they grew revenue $13 billion. So all these metrics feel pretty good. 13 times the last 5 years free cash flow, higher return on invested capital. Everything I see here I like. Gross profit is 46.8%. This means for every extra dollar they sell, they get 46.7 cents of that going to the bottom line before overhead and taxes. Now, the reason this is important is companies with high gross profit, as they increase their revenue, more and more can be put into that bottom line number. That's what's really important. So let's see what analysts think about PayPal. Analysts think PayPal is going to make $5 a share this year, $5.14, growing to $8.51 in the next 4 years. That's 10%, 12%, 12.5%, 11%, and 18.5% growth. Now, they're analysts. They have their bias. The key here is to remember that you're here to do your own analysis. When stocks are beaten down, when a company's beaten down like this, it's important to take a look. Because I always hear people saying, the company's dead. Well, this is revenue growth right here. Not much for a dead company here. So is there a mispricing here? Now, guys, there are stories and there are numbers. We have to merge those together. That's why we use the stock analyzer tool. Whenever I'm looking at a company, I start with stock analyzer tool. If it's within the ballpark of my investment idea, then I go to do a little bit more research, tidy up my numbers, and finish with stock analyzer tool. So we're looking at stock analyzer tool. Let's pull up PayPal. And the last time I did it, March 28th, I did a 10-year analysis. Now, guys, look at these conservative numbers on revenue growth. I did a 10-year analysis, 3%, 5%, and 7% revenue growth. More profit margin. I did 12.5%, 14.5%, 15.5%. Free cash flow, I did 16, 20, and 24. Now, the 20 might be high, but remember that higher gross margin hopefully can add more free cash flow to that bottom line. PE and price of free cash flow 10 years from now. Guys, I put 14, 17, and 20. The finance space and this payment processing space is getting a little crowded, and I'm being a little conservative here. So I put 14, 17, and 20, even though their return on capital is higher and getting better. This should be driven by growth potential and by return on capital. That's really important here. And of course, I did my 9% desired return. Remember, I'm not buying anything at 9% return. This is just to say, hey, what's the intrinsic value? If I want to match the market, 9 or 10% return, what am I willing to pay? You have to have a higher desired return for individual stocks. You need that margin of safety. I hit the analyze button, boom. I have a low price of 60 to 75, high price of 130 to 190, middle price of 90 to 120. If my middle assumptions occur, I will get a 16.87% return based on cash flow if I pay today's price of $72. Now remember, if these stocks don't hit the prices I want, I will not be buying them. That's what's really important. You have to be disciplined enough to follow our 5th tenet of our principle-driven investing, and that is a good story can become a bad investment if you pay the wrong price. This company at 72 is a lot different than at $720 and very different at $7.20, assuming the future is all the same. That's the big key. If you don't see the difference in that, you've got to realize that you're probably speculating, you're not investing, which is the first tenet of our principle-driven investing. Now, the second thing I'm looking to buy in is SCHD. Guys, the reason I'm buying SCHD, it's an ETF that's a dividend-paying ETF. Now, you've got to remember, I don't like it when people say, I'm a dividend investor. The SCHD portfolio matches my goals in life. I have real estate, I have businesses, they generate cash flow. I have enough in life. I don't need to make huge returns. SCHD is more consistent, boring companies, slower growers, but they pay a good dividend. Right now, SCHD is paying a 4% dividend yield. And if the stocks fall further, that's going to increase. I'm fine with that. I'm okay. It fits my strategy. Now, does it fit yours? I have no idea. But that is an ETF that I'm adding to my portfolio every single month. And better yet, with all these stocks, I'm using cash secured puts as a part of buying them. What that means is, look, for example, at PayPal. Let's say I wanted PayPal at $65, not 72. Somebody will pay me money to allow me to wait for the stock to hit $65 a share, and then I will buy it at that point. I'm going to make money to wait. This is a very important process of selling options. If you understand value and understand what you want to buy a company at, you can be paid money to wait for the stock so you can buy it at a lower price. If that sounds too good to be true, I want you to do me a favor. Download this PDF. Click the link below. We will email you this PDF. You got to take a look at it. It'll change the way in which you look at investing, and it will force you and help you stay busy so you're not buying stocks that you love at the prices you don't love. It's very important you got to pay the prices you want. Now, stock number 2, Southwest Airlines. Now, guys, this is what I've been talking about for a while. Very simple play here. Southwest before COVID was doing 10 to 15% bottom line margin. In the last 5 years, they've done negative 0.65. Last year was 2%. My entire play on Southwest is they had computer issues. They had 737 MAX issues. They had a lot of problems. And I feel like they're going to end up getting back to their 10 to 15% profit margin. And I'm willing to wait for that because they have record revenue. If you look at their revenue, look at this income statement here. Revenue of $27.58 billion. Before COVID, their highest year was $22.43. And like I said, they were making billions at that point. This last year, they only made $546 million. They've been bogged down with costs, turnaround costs, changing things around. I like the fact they're doing that. Look at this. Look at their 8 pillars. Garbage. 6 X's, 2 checks. That's why you can't make a decision based on the pillars. There's more to this story than a lot of red. There's a lot of potential here, in my opinion. In fact, go look at analyst estimates. Look at this growth in EPS, $1.65 this year going to $4.65. The stock's currently at $31 a share. It's selling for like 6.5 times the profit in 2028, according to analysts. And it's only 2 of them, so I get that. But I look at it saying, why would Southwest, the best run airline in history, suddenly start sucking at running an airline? Maybe they will. But I think the juice is worth the squeeze here. And let me show you what I mean by that. The stock analyzer tool will show you exactly what I mean. I was more conservative here. Let's show you 2, 4, and 6% revenue growth, which I'm fine with. Profit margin. I'm going to go 7. No, I'm going to go 8, 11, and 14 because they've done all of these. So even my highest number here, they've done. PE, best run airline. I'm going to give it 14, 17, and 20. And again, my 9% return. The stock's currently at $32 a share. This is why I'm so bullish on Southwest. Now, this is a lot of margin of safety. My lowest assumption assumes, even my lowest assumption occurs, I could still make 16.9%. That's a lot of margin of safety. Does not mean I'm going to be right. Remember, that is very difficult to do. You can't be right every time. But if you had 30 situations with these kind of parameters, you would make a lot of money. You would absolutely make a lot of money. That's what investing is all about. So again, with Southwest, I can sell some very, very valuable options here. Allow me to get much lower prices and be paid 10 to 15% of the cash held in my account on an annualized basis. That is awesome for me. So again, click the link below. We will email you our options PDF. It'll absolutely change the game for you. Stock number 3, good old Target Corp. This stock has been beaten up. Wild fluctuations. All-time high, 247. 52-week high, 166. 52-week low, $87. It's currently at $96 per share. Now, this is a company that's just been beaten down. Look at this. It's selling for single-digit price of free cash flow. Almost single-digit PE. Guys, I have to ask myself, do I see a world in which Target is gone forever? It could happen, but Target's done a great job of, one, appealing to their target demographic, which is women, and two, making it easier and easier to buy there. They're doing partnerships with Ulta Beauty, another store that women love. I just look at these things and think to myself, okay, yes, retail has changed, but I look at this also going, okay, is this 8 pillars? It's 7, but this is long-term liabilities, one of them. That's their leases. They all have these huge leases, so I'm not worried about this. They pay a very monstrous dividend, 4.6%. Who knows if that's going to stick around or not? I will tell you this, though. They generate $4.5 billion of free cash flow, and their dividend only costs them $2 billion of that. Less than half of their free cash flow is eaten up by their dividend. That's incredible. So I look at this saying, okay, the stock has fallen a lot. I started buying sub 130 and I bought all the way down. This is a great example of a company that I can sit there and sell covered, cash secured puts on and buy it at lower prices and wait for the stock to hit the prices I want. So let's go to the stock analyzer tool and see exactly what price I'm thinking to myself Target could be worth here. So 10-year analysis, I did 2, 3.5, and 5% revenue growth. Now guys, they're going to open more stores and we have inflation. These could very well be very low numbers. Profit margin, I did very low, 3, 4, and 5. Same with free cash flow. PE, look at this. It's got above average return on capital and its target. I put 15, 18, and 21, and I'm going to do my 9% desired return. I hit the analyze button. The stock's currently $96 a share. And look, I have 100 on the low side, 255 on the high side, 165 in the middle. And remember, these returns include the dividend, so don't add dividend to that. Now, guys, you've all heard of the Magnificent Seven. These 3 stocks here are not the hype Magnificent Seven. But I have my own personal Magnificent Seven that I think is going to outperform over years to come. I made this video to show the fact that over the long haul, that hype tends to underperform and good stable companies at the right price will do better. So please watch this video. I think you'll learn a lot from it. Thank you for your time.